Have you ever looked at your bank account and wondered why your money feels like it is working harder just to stand still, even when the headlines say the economy is improving? For many Americans, the last few years have felt like a quiet financial storm. Prices at the grocery store keep climbing, rent feels heavier each month, and market swings turn savings into a source of stress instead of security. In moments like this, one decision made far away in Washington can quietly shape your everyday life. That decision is what the Federal Reserve does with interest rates. This is Crypto Brain Power, a beginner-friendly channel created to help everyday people understand how markets really work, without hype or shortcuts. Here, the goal is simple. We slow things down, explain the basics clearly, and focus on learning instead of guessing. Before we go deeper, let me ask you something. What stock market or economic topic do you want to understand better next? Share your thoughts or questions in the comments. Your ideas help shape future videos. Subscribe to support the channel and continue learning with us. Now let us take a calm, honest look at Federal Reserve rate cuts and how they could change the way your money behaves in 2026. To understand rate cuts, you first have to understand the feeling behind them. Interest rates are not just numbers. They represent pressure. When inflation rises and prices move faster than wages, the Federal Reserve raises rates to slow things down. Borrowing becomes expensive. Mortgages cost more. Credit card balances grow faster. Businesses hesitate to expand. Households delay big purchases. Growth slows on purpose. But eventually that pressure becomes too much. Jobs start to feel less secure. Companies reduce hiring. Market optimism fades. That is when the conversation changes. The Federal Reserve begins talking about rate cuts. A rate cut does not mean the economy is suddenly healthy. It usually means policymakers see enough risk ahead that they want to prevent deeper damage. In past years, Americans watched every Federal Reserve meeting closely. One sentence from the chair could move the S&P 500 in minutes. A single comment could send Apple or Amazon shares rising or falling before lunch. By 2026, if rate cuts arrive, they will not show up all at once in your life. The effects arrive slowly, unevenly, and sometimes uncomfortably. Start with savings. When rates are high, money in high-yield savings accounts feels like it is finally doing something. Platforms at banks connected to Fidelity or Charles Schwab may offer yields that look respectable compared to past years. But when rates are cut, those yields begin to shrink. The interest you earn on idle cash quietly declines. It is subtle, but over time it changes behavior. People start asking if holding too much cash is worth it. Then there is borrowing. Mortgage rates, auto loans, and business loans often begin to ease when rate cuts approach. For some families, this creates hope. Refinancing becomes possible again. Monthly payments shrink slightly. First-time homebuyers start watching listings with cautious optimism. But lower rates do not guarantee affordability. If demand rises faster than supply, prices can still climb. In the stock market, the emotional shift is powerful. When rates fall, investors begin to look forward instead of backward. Growth companies often benefit first. Firms like Tesla, which depend heavily on future earnings, tend to react strongly to lower rates. Apple and Amazon may feel renewed interest as borrowing costs ease and consumer spending shows signs of life. But here's where confusion often sets in. Markets can rise even when the economy feels weak. You might see green numbers on your Robinhood app while layoffs make the news. This disconnect is not manipulation, it is anticipation. Markets move on expectations, not today's reality. Federal Reserve rate cuts also affect how investors interpret economic data. CPI inflation reports suddenly matter differently. A slightly higher inflation reading might not scare markets if growth looks fragile. Jobs reports are no longer just about strength. Sometimes weaker job numbers push stocks higher because they increase the chance of further rate cuts. This emotional contradiction is one of the hardest lessons for beginners. It feels wrong at first, but understanding it builds patience. Risk does not disappear when rates fall. It changes shape. Easy money can encourage speculation. Investors chase returns too quickly. Bubbles form quietly. History shows this pattern again and again. That is why discipline matters more than timing. Long-term investors often focus on broad exposure instead of predictions. The S&P 500 is not immune to downturns, but over decades it reflects the growth of the U.S. economy itself. Rate cuts may lift markets temporarily, but long-term results depend on earnings, innovation, and productivity. Platforms like Fidelity and Charles Schwab often emphasize diversification for a reason. No one knows exactly how 2026 will unfold. Federal Reserve policy reacts to data, and data reacts to human behavior. Inflation can surprise. Jobs can shift. Global events can rewrite forecasts overnight. The most important change rate cuts bring is psychological. Fear slowly gives way to cautious confidence. People stop checking their accounts every hour. They start thinking in years instead of weeks. That shift alone can improve financial decisions. Learning this takes time. Many investors remember panic selling during market drops, only to watch prices recover later. Those moments hurt, but they teach perspective. Markets reward patience more often than prediction. As 2026 approaches, rate cuts will not be a magic reset. They will be one chapter in a longer story. A story about balancing growth and stability, risk and restraint, hope and realism. If there is one mindset worth carrying forward, it is this: your money does not need excitement, it needs consistency. It needs time. It needs you to stay curious, cautious, and calm when others rush. Understanding how Federal Reserve decisions ripple through savings, stocks, and daily life turns fear into awareness. Awareness turns into confidence. And confidence, when grounded in patience, becomes one of the most valuable financial skills you can build. This video is only for educational purpose, not financial advice.